Well, first and foremost, the philosophy is to be a value investor. Value investing we define as free cash flow, very much focused on identifying sustainable free cash flow. So the first part of the process is valuing all companies on that basis, and we value them consistently, doing all our own research and our own models, so we're able to identify where we believe value exists on the basis of sustainable free cash flow. That's the first half of the process and first half of our investment philosophy. The second half is around understanding why stocks are cheap. Once you've identified the value based on our approach, we then have to get into the reasons why the company is cheap. And the second half of the process, which we call our conviction aspect of the process, is about identifying those reasons and either dismissing those reasons as being invalid or temporary, for example, like a cyclical economic slowdown, or maybe there's a structural concern of the market. And in that case, we try and factor it into a valuation range. And our best ideas are ones that look undervalued based on sustainable cash flow. But even when we factor in what the market is concerned about and assume the market is right and we are wrong, the stock is even showing upside on that scenario. Okay, well, one of our current holdings, which is a bit unusual, I guess, for mainstream fund managers, is Magellan Financial, obviously the well-known quality global fund manager. Magellan is a good illustration of how we look at companies. We are free cash flow investors, and our fund managers typically generate very good cash flows because they don't need to hold working capital. They don't need to invest in factories and I guess expensive equipment, so we see a very good level of free cash flow generation. The other thing that we typically like about fund managers is that they don't generally carry debt. So while their revenue does link to the level of the share market, they obviously when things go wrong, they're not compounded by the fact that they carry lots of debt. And our process does deduct debt in full from our valuation or add back cash. So Magellan has net cash. The third, I guess, style thing we like about Magellan is that they have a lot of franking credits. So while they have earnings based on offshore investing, they basically generate fully franked dividends. So there's quite a few things that attract us from a style. Obviously, what we're looking for from a fund manager is that they have genuine skill, ability to outperform. What we find with Magellan is it's perceived by people as being a risky stock because it's a fund manager, but actually their fund is all based in US dollars. So once again, if things did go particularly bad in the world economy, we'd probably see the Australian dollar fall, which would provide some offset. So Magellan's funds under management might not fall as much. So we think the market is misperceived how risky it is. The other aspect is they're obviously a quality investor, which would typically tend to perform better when markets are down. The one aspect we see in Magellan, which we think the market is missing, is the performance fees. The way the performance fees are structured is, even if they underperform, but the market is rising, they don't actually have to make up that underperformance in future periods. So we think that statistically they will always get a performance fee through time, higher than the market is expecting, and we've factored in a level of performance fees, a modest level, but a level of performance fees into our sustainable cash flow, which we think the market keeps getting surprised on and keeps missing. There's a few aspects in terms of the market's misperception around risk, the strong cash flows, the net cash, the franking credits that we think make it a good style fit for a free cash flow based manager like Merlon.